Hello, good afternoon. My name is Erin Payton, and I'm the Executive Director of the 19th Century Charitable Association. Thank you so much for attending today's program, Today's Markets with Craig McWilliams. We are going to be bringing him on shortly, but I'm going to talk a little bit while you all come into the attendees portion. A couple of things. You guys are all attendees, so you're not going to be able, we won't be able to see you, but you'll be able to see us. If you do have any questions or comments for Craig during the program, you can leave them in the chat function or the Q&A. Either one is totally fine, and we'll get back to you towards the end. There will be a Q&A with Craig where you can, then I will unmute you and you can ask the question yourself, which is really fun because you can talk to him directly. In the meantime, hopefully you're relaxed and enjoying this lovely Monday. I'm going to wait just about one more 20 seconds while we get a few more people on. And then I'm going to bring on Diane Moses, who is the program chair for our organization. She has been working on putting together our next season of programs for 2021. And I can tell you right now, they are amazing. So be prepared to be wowed and astounded and amazed. They're going to be really great. So, but for now, I'm going to bring on Diane Moses, our program chair.
Craig McWilliams is the portfolio manager of the HLD Hedge Fund, a diversified portfolio of listed dividend-paying securities protected by options and leveraged in a portfolio margin account. He has 20 years experience in trading, alternative investments, and tax-advantaged strategies. He is also a successful entrepreneur and business developer. Once a financial advisor, he specialized in preparing clients for the realities of living past their active working lives, preparing for Medicare and long-term care expenses, and legacy planning. He holds Series 7, 65, and 63 licenses, and is also licensed in life and health insurance lines. Mr. McWilliams will examine the broader high-level history, today's concerns, and certain alternative strategies that may be employed. Let's give him a warm virtual welcome.
All right. First, let me say thank you very much for this invitation. It's quite an honor. I know that I'm in very esteemed company as a speaker to the 19th Century Charitable Association. I think that you do some very, very fine work. I attended a lunch before the pandemic hit, and I very much enjoyed my brief time there. I met a lot of very interesting people. I just thought, wow, this is the sort of environment that I would love. Very inquisitive, knowledge-seeking people, and well, I just felt very much at home, and you made me so thank you for that. So with that, I'm going to share my screen so that you might see a presentation that I've developed for this luncheon, virtual luncheon. And so we're going to be talking today about what's going on in the market, but in a context which I hope will enable people to perhaps think about their own situations and what they might be able to do. There's a lot of uncertainty out there right now. There's a lot of fear. I'm not going to address the pandemic per se, or what I think will be the course of this, either from a regulatory or even a biological perspective. I think that the powers that be and the people that we pay attention to via the news media and officials probably have a better handle on it, and I would just encourage you to stay abreast of the information, but not, shall we say, intimidated by it or made anxious by it. Try to moderate the amount of information that you bring in, is I guess what I would say to just about anybody that's being affected by this. Great Point Capital is the broker-dealer where my licenses are. We have a registered investment advisor as well. My hedge fund is also a registered investment advisor. What this means is that I'm dually licensed, which means that I work not only as a fiduciary, but also as a broker. There are just certain times when you wish to place something with investors that requires a commissionable type event. This is by FINRA and SEC guidelines. Typically these that I do nowadays are either private placements or Regulation D offerings. I don't really sell and buy stocks and bonds for people any longer, nor do I have an individual clientele as it pertains to money management. That's something that I typically refer to other people. So just want to clarify that. And so the basic nature of this conversation today is to explore, as we said in the beginning, kind of what's going on and where we might be going and how you might think about your investments and your other financial products that you may or may not own, and how that might pertain to what's happening today and where you're going with your life. So let me get to the next slide. This is from Warren Buffett, and it's back in 2008, but I think that it sort of sets the stage. I'm not going to read it verbatim, but basically what he's saying is that, you know, no matter where you are in history, whether it be World War II or World War I for that matter, over the long course, the American economy will survive, the stock market will be there. We'll be able to look back on this time, hopefully with some insight as to what happened to us, how we coped with it, what did we learn? Did we come more together as a nation, as individual families, or did we not? Hopefully it's the former. But it's very interesting to look at the numbers in this quote. They were from 2000, or rather 1929, the Dow was trading at a low of about 66 points. And we rose to 11,000 as of 2008, and as you know, 25,000 plus more recently. So just let that sit in for a second, and then realize that that's about 174 times or 5.3% compounded annually. It's not a bad rate of return, and it's an average rate of return, and it's a number that bears remembering as we move through this entire presentation, 5.3%. Now, I've seen a lot of financial advisors tell their clients that they should expect 7, 8, 9, 10%. Warren Buffett goes on in this quote to say that people who expect a 10% annual return, envisioning that they're going to get 2% dividend yield from the S&P 500 and 8% price appreciation, are implicitly forecasting a Dow of $24 million, or 24 million rather, by 2100. That's an enormous number. I'm sure you find it rather shocking. I know I did when I first read it. And I thought, oh my gosh, how could that possibly be? And here's where I have to hasten to add. I'm not offering investment advice with this seminar. I'm not recommending that you take any one of these strategies and put it into effect. I'm not advocating the buying or selling of securities or the liquidation of portfolios or the plowing all your money in at this time, certainly. What I'm hoping is that this becomes educational for you. And I should also hasten to add that the past performance of investments doesn't guarantee future results. And also, as we speak about diversifying across different asset classes, that also does not assure a profit or does it protect against loss. So with those disclaimers that my broker-dealer insists I make, we'll carry on. So a little bit about me. I started out this life wanting to be a scientist. My mother's cousin was a leading neurophysiologist, and he studied the migration of birds. There's a species of goose that migrates from east to west, and that was something that caught his fancy, and he did a doctoral thesis in it. So from a very early age, I was given access to materials that perhaps many kids aren't, and I began my life thinking that I was going to be a research scientist, and indeed I pursued a track that way. I was torn between going into medicine, because I always wanted to help people, but I thought I could perhaps do more work and more help, be more helpful to more people if I were to do something along the lines of research. So I obtained a Bachelor's of Arts, which is what it was offered in biochemistry and molecular biology from Northwestern, and a doctorate, all but dissertation, in pharmacology from Loyola. What that means is that I passed my comprehensive exams, but I was unable to defend my thesis. There were several issues going on at that time, not the least of which was that money was running out. And it was very difficult to make a living, and I eventually left the program without securing the doctorate. It was a terminal PhD program, and I was unable to get the master's. So as I moved through life, I found myself working at Argonne National Laboratory out there in Lamont, Illinois, not Batavia, Lamont, Illinois, as a software engineer. I was out there for 11 years, and I wrote codes. I taught myself to program computers, and I wrote codes that track weapons-grade nuclear materials in former Soviet countries. It afforded me the opportunity to travel. It afforded me the opportunity to see what is the aftermath of communism, full-blown. It's a rather shocking thing to see, I will say. And it afforded me the opportunity to meet a diverse number of people from so many different backgrounds that if you haven't traveled abroad, you just simply can't appreciate it, even in this country, I think. As that project wound down, I was invited to start a company in quality assurance. We were going to take my data analytics skills and my software engineering skills and build an automotive services company. We did that, and in 3 short years, we were ranked by Honda of America Manufacturing as #2 in North America, quote unquote, setting the bar. The major driver behind me starting that company really was the fact that the massive competitor in that space, and the #2 for that matter, had a reputation for treating their people very poorly. They basically paid their people less and less per hour, considering them to be essentially, I'll use the word slave. Hopefully that's not too offensive or triggering to people, but that was their mentality. I found it despicable. And so I decided that I could build an automotive services company where I could pay people more and do so through the efficiencies of automation. In other words, we were able to have fewer customer service staff and fewer HR people because our invoices went out on time and our paychecks went out on time, and they were always accurate. And that was a contribution at that time. I got it to a significant valuation, and then 2008 happened. And suddenly we went from a rather significant amount of revenue to nothing. Now, I shall say also at that time, and it bears remembering too in this conversation, that I covered 75% of my people's medical insurance. I thought of that as an obligation. We had to build it into the price structure, and we were always under pressure to reduce our prices from the manufacturers, and it was difficult. But I covered 75% of my people's healthcare premiums, and they were real healthcare plans. These were full medical plans with minimal deductibles by today's standards, some $1,200 a month or rather $1,200 for a year for a family of 4. The premiums ranged anywhere from, I think it was like 175, because I blended men and women together. Women have always been more costly to insure, but in order to equilibrate things, I blended them together. And I think the families for 3 or more people were, like, as I recall, $525 a month. So this was a relatively inexpensive by today's standard cost, but of course, if you try to do that today, it's very, very difficult and very expensive. As 2008 unfolded and the market crashed, the demand for automotive really crashed along with it. And I went back to work for an individual that I had been with before on the S&P 500 pit, where he was a trading manager or desk manager for one of the largest locals on the Chicago Mercantile Exchange. This particular individual might have $250 million trading at any one time. And my job was to come up with position trades, statistically significant trades that might make him money. And there's some stories about that. I'm going to try to get to the meat of the presentation now, so I'm going to keep moving forward. And as I took this experience forward after working on the floor and after having to collapse my company, a friend needed some help turning his Medicare medical supply company around, which I did. And I learned all about Medicare and Medicare insurance. And that's where I first got my insurance licenses, because I decided that the best way to help that company and to help our reps, I had 80 reps reporting to me, was to, first of all, bring agents from some Medicare insurance companies like Aetna and United Healthcare and Blue Cross Blue Shield and Humana and others, bring them into the company as medical supply reps and to turn my medical supply reps into agents. So naturally I needed a license, and this is where I re-entered the financial world. So I turned the company around. I went off and I formed a Medicare insurance agency. We're going to get into that in a little bit. I think it may be of interest to some people on this call today. I was recruited by a very high net worth insurance company up on the North Shore. And I learned about life insurance products as they are used by the very wealthy, and how that might translate into mass affluent, normal people, middle-class people like us. At least I presume many of us on the call are. And at the same time, those doors open to some venture capital firms on the North Shore, something that we'll speak about a little bit down the line here. And then forming a hedge fund. Essentially, it's an options hedged, leveraged dividend fund. So it's a hedge fund in the truest sense. We are leveraged, and we use options to protect the downside. It's something which bears some mentioning, but not a lot of detail on this particular call. And as Diane said, I have several securities licenses and insurance licenses as well. So while I was in the financial advisory world, working for one of the major insurance companies who's essentially a household name, something just didn't feel right. There was an enormous pressure to produce, to generate commissions and fees. And oftentimes it was, I thought, at the sacrifice of thorough planning. Me being a data wonk, I really gravitated towards the financial modeling and planning part of the process. Yet at the same time, I really wanted to help people, but it became a very long and laborious process. I will say to you that I never did refine it very, very well. But at the same time, I feel as though I'm on my own treadmill, and it's really hard for me to jump off my treadmill onto someone else's treadmill and get on board with their sales program. And so basically, I found myself moving on from that life and moving into venture capital at that time. I found that the herd mentality approach to investing was more akin to a race to mediocrity. That's not to say that there aren't really great financial advisors out there. I'm sure many of you have financial advisors that you dearly love, and I encourage you to keep with them and show them the love that they deserve. But it was just, my particular perspective on the whole thing, and I think that you'll see how that affected what I did next coming up or down the line. I found that a lot of financial advisors, for example, diversify. This is a Peter Lynch term. As you may know, he ran Fidelity Magellan Fund for a number of years and actually was instrumental in its early and midlife growth. So diversification refers to diversifying for the sake of diversification. We're going to get into that just now. Many financial advisors and wealth managers, financial planners, use and promote an idea, a theory that was introduced by a Nobel laureate, Harry Markowitz, in 1952. And it really calls for bringing your investments to the end or to the edge of what's known as the efficient frontier. The label here on this particular image says best possible CAL. It's actually supposed to be CML, capital markets line. So the idea here is that you're trying to get to a low volatility, in other words, a pretty fairly stable price situation or value situation, yet get yield. You've all heard of risk reward, that reward comes at the expense of risk. That's not necessarily so, as we'll see, but this is the thinking of many portfolio managers today. And here's the net result. Essentially, and you've probably all seen these mosaics before, they will rebalance on some periodic basis, whether it be quarterly or annually. And the typical methodology is to lop off the winner and redistribute the winnings into mediocre and losing silos or asset classes. The reason being is that, well, I won't say no one, but very few people feel confident in predicting what will be the next asset class performance, or which will be the leading asset class in terms of performance in the following year. And you know what? It's not a bad strategy. It's just that it's sort of, in our business, it gamma reverts, right? It sort of reverts back to the mean of performance. And that's, again, it's not necessarily a bad thing if you're using your securities portfolio for the reasons that they were, in my opinion, intended, which is inflation tracking and some money growth, and of course some income too as well. The aha moment, in my opinion, should have been in 1991, when that same Nobel laureate and modern portfolio theory founder, Harry Markowitz, wrote that MPT was never meant to apply to investment problems of a household. Rather, he intended it for large institutions like endowment funds and insurance companies that live in perpetuity. Now, there's very few financial planners or money managers that will say this to you, but this is in fact the intent of that. It bears understanding for which and for whom it was intended, and if it's not intended for you, then what should you be doing? Hopefully we can elucidate that coming up here. So there's many different schemas of what are and are not asset classes. To simplify and distill it down, you have an asset class of insurance, annuities, and pensions, which are essentially annuities. These are sometimes referred to as actuarial-based financial products. There's a life expectancy component to them. There are investments. Investments span the range of liquid and illiquid securities that, for example, may be fixed income, or they may be equity in nature, or some combination thereof. There are convertible debentures, for example, preferred stocks, real estate investment trusts, and others. Certainly something that with which many people are very familiar, but perhaps there's some enlightenment that can occur here today as well. Real property, this includes not only land and structures, buildings, but also art, precious metals, that sort of thing, tangible property, some depreciating assets, some hopefully appreciating assets, and alternative investments. So each of these has a space in a modern portfolio. It is a goal, I think, for middle class and upper middle class people to diversify into all of these things if it's appropriate based upon your age and your own particular goals. And I'm hoping that I can elucidate some of that as we move forward. Starting, insurance products and annuities insurance products offer you some indemnification. They are typically tax advantaged, meaning that cash values or sub-accounts can grow tax deferred. There is the ability to create a fixed income alternative using a combination of life insurance and annuities. Essentially, an immediate annuity benefit, which is the payment that comes out of the immediate annuity, can be used to purchase a universal life product that can last for a person's lifetime, thereby repaying the principal which is invested at some point in the future. And the yields on these particular instruments can be greater than similarly rated corporate bonds, for example. Life insurance comes in a private placement flavor. This can be a very interesting way for people to shield income and growth. Life insurance benefits and annuity benefits may not inflate with the cost of living. There are some modern products that are adapting to this need, I should say, something to think about. And also, this is a good time for me to bring up the fact that life insurance and annuity products can be exchanged. So if you cash out of a life insurance product, or if allowed an annuity, you may have to pay a gain on whatever the difference is between the sale of the cash value, or I should say the cash value and the premiums that you've paid into it. However, if you do a 1035 exchange into another life product, you can do so by deferring taxes. This is a very good way, I might say, and I've done this for people where they're carrying a loan against a whole life product. It's a way to extinguish a loan. Insurance companies don't like that terribly much, but it's a very effective strategy for some people at the right time. Investments are the products with which most people have more experience and more familiarity. They may allow for growth, we certainly hope. If you were looking at investments from the beginning of the year through the middle of March, that may not be a true statement, but we've since recovered, thankfully. They may provide an income. They may be a good hedge for inflation. And they offer speculation, which is not to say that I'm advocating that you speculate in the markets. And I'm also not suggesting that all investments are a speculation. I'm just saying that it is a property of investments that can't be disregarded. Real property will offer a different correlation to overall market activity. It may yield a possibly tax qualified income, which is a benefit. It may have the appreciation or the potential for appreciation. With your own home, for example, you can contemplate a reverse mortgage if that makes sense to you. I really know very little about reverse mortgages. I just merely offer it as something to engender some thought by people. You should seek an expert for something like that. But real property, in the case of real estate now, not art or valuables, as was the case before the 2019 Tax Act, offer you the opportunity to also exchange into other investment property in a tax-deferred way. And we're going to look at that down the line as a strategy that people may want to consider. And then there comes a category or asset class which is near and dear to my heart, which is alternative investments, which can offer a fundamentally different correlation. These can include hedge funds. Again, not advocating that people consider hedge funds. Certainly, a lot of hedge funds have not performed very well at all over the last many years. Private equity, venture capital, and some other sorts of offerings that we can, discuss as we move through this presentation. I want you to really take a step back for a moment and think about one thing, and I think that it came to me suddenly this morning as I was contemplating what I was going to speak. For most of us, maybe for all of us, your most important asset is your health. Medical costs have been skyrocketing. The insurance premiums that I paid for my 68 families that were on medical insurance at my company were about $525 a month. That same insurance may go for $2,500 to $3,000 nowadays. The deductibles for that insurance are no longer in the $1,200 range. They may be $5,000 or $6,000. I've seen $12,000 deductibles. It's really unaffordable for many people. And it's something to be avoided at all costs. And the best way to avoid insurance costs, if you are able, is to take care of your health. But at the same time, I hasten to add that for people that are already in a shall we say, knowingly or unknowingly, wittingly or unwittingly compromised situation, there are types of insurance about which many people have no idea, so-called catastrophic or hospital insurance, otherwise sometimes known as cancer, heart attack, and stroke coverage, which are engineered and constructed to pay those massive deductibles. I mean, let's face it, in an average year, most people don't meet most people, I've met people who do this every year, but most people don't meet their deductibles. And it's usually some catastrophic event which causes them to have to pay the full deductible. If it's an automobile accident and the guilty party is insured, whether it be you or someone else, oftentimes the insurance will cover an amount equal to or greater than the deductible. But if you're walking along one day and some, God forbid, happens where you have a stroke or a heart attack, if suddenly you're diagnosed with cancer, there's a relatively inexpensive type of insurance known as cancer, heart attack, and stroke insurance. And I would encourage you to look into that. if you don't already have it, and if you suspect it or think that perhaps it could be of use to you. And I can't encourage enough diet and exercise. I live in a high-rise condo here along the lakefront, and people, when they see me in the morning, if I don't have my bike, they're like, "Where's the bike? You know, did you swim today? You know, did you go to the gym?" And I try to be an example for people, and it brings me, I will say, considerable joy, happiness, and less anxiety. And if that helps, I sincerely hope that it does. My view of the dynamics of wealth and my conversations with people when I was practicing individual financial advisory were that many people have a relationship with money. They can be very, very wealthy and they can fear losing money. They can be very, very wealthy and have no regard for money and spend it foolishly or lavishly. There's all kinds of different personalities and all sorts of different relationships to money. The fear of having it, the fear of not getting it, the fear of losing it. Typically, money comes with a lot of anxiety. And it's really necessary to contemplate what are your goals and aspirations and what is your plan. Planning is a very essential thing that I encourage everybody to do with someone that they trust. I would hope it would be somebody who's informed, and even if you trust your uncle or your aunt or your brother-in-law or whomever else it may be in your life, if they're not licensed, if they're not trained, I would suggest that perhaps you tippy toe into a relationship with somebody who is. And if you've been with a financial advisor for a very long period of time or even just a shorter period of time, perhaps some of the points that we discuss in this presentation may be discussion points for you and that person in the future. But typically, the dynamics of wealth and income revolve around the flexibility of a financial product, whether or not it provides growth or asset appreciation, as well as income, and what, if any, guarantees are offered. Now, I'm not speaking about the kinds of guarantees that you see at the bank. The Federal Deposit Insurance Corporation, FDIC guarantees of $250,000 per account, per institution, that sort of thing. No, what I'm talking about are corporate guarantees, contractual guarantees that are offered by, for example, life insurance companies and other companies that offer financial products. These institutions can be many times larger than many banks. Their guarantees are solid, and there are certain insurance funds, for example, and every state has an insurance fund. To my knowledge, and I looked at this recently again, not a single in-force life insurance policy in the United States has ever failed to pay out. And that becomes especially important as we look at some of the flexibilities in life insurance policies. Typically, people look at some of these financial products as not having a lot of flexibility. We all know that if you invest in an annuity, you're pretty much locked into that annuity once you annuitize. It's very true. There are situations where you can do a 1035 transfer of remaining value out of that product into some other insurance product. So there's some minimal flexibility. But ultimate flexibility happens when you have liquid securities, whether they be stocks or bonds or real estate investment trusts, things that trade publicly on the market that have a price that you can look up and, shall we say, Google or the Wall Street Journal, and you can click a button or call a broker and liquidate. Obviously, with flexibility, there's certainly there's not much guarantee. And it's something to be considered. How much flexibility do you need for your plan? Are you planning for spending a lot of money towards the end of your life? And therefore, will you need flexibility then, or will you need to be saving money along the way? There's many different ways to architect a successful landing. I'm not sure of the statistics now. I endeavored to find some current statistics this morning and was unable. But at one point, I was told that some 50% of Americans depend upon Social Security for their retirement. And of the other 50%, I mean exclusively, and of the other 50% that have retirement assets, some 85% will outlive their money. And it's a really, really scary thing. when I was building a Medicare medical insurance agency, I would oftentimes meet people in HUD housing, state and government sponsored or federally sponsored housing, some of whom had been mass affluent people, meaning middle class people that had companies and jobs that we all might have. And suddenly some trigger, whether it be an illness typically, or an egregious divorce, or a really bad lawsuit, which can happen to entrepreneurs and others on occasion, of course, and suddenly they find themselves bankrupt. And it's a terrible, terrible thing to end up in housing like that. It became a great passion of mine to try to help people make sure that they don't end up in housing like that, and that they can safely and reliably and joyously live out their years in the place where they want to live. So how is it possible then to not make your plan? Well, failure to plan is planning to fail. We've all heard that adage before. But you have to understand wealth erosion. What are the things that can cause your net asset value to decline? What are the things that can sap that 401k plan or IRA that you have of its asset value, or any other holdings that you may have, for example? Well, there are taxes, certainly, inflation, driving down the value of money, and uncertainty. Uncertainty should ring especially true in the times we have today. I personally have never seen uncertainty like this, although the country has. It can be very scary out there. We try to stay very abreast of certain indicators, for example, as we try to manage money. But on the other hand, as I indicated earlier, sometimes I think that if you watch the news too much, or if you pay too much attention, that you can walk around in a state of complete anxiety most of the time, and I don't advocate for that as well. So what can you do? I suggest that you can think like a business. You can treat your life and your accounts like a business might. You have an income, whether it be through a pension, whether it be through Social Security, whether it be investment income, property perhaps, other sorts of holdings. You have an income, you have assets, and you have expenses. So naturally, before getting into this slide, controlling your expenses is a very important thing for most people. Most people budget quite well. My wife does that. I'm terrible at it, I will say right now. But understanding the wealth eroding factors that we spoke of before and trying to mitigate them is a really important part of comprehensive planning. You should hedge inflation. What I mean by hedging inflation is that you should have assets that appreciate along with or better than the rate of inflation. That way your asset value can maintain at least until some point in your life. And this is a really good time to also say that something I probably should have said before. The challenge of financial planning now has never been greater. It has never been greater. And I want you to really bear that in mind as we get into some of the alternatives that I speak about later on that are extending life, because we are living longer and longer as a population now than ever before. And I can absolutely promise you that there is medical technology in the offing that is absolutely astonishing. So that challenge and that joy is going to become even greater as we move forward. Taxation. I don't know a lot of people who like paying tax, but everybody wants somebody to pay tax, right? We all want to see that government keep on doing what that government does. There are some policy discussions that could be had. I would love to engage in those conversations sometime with the members of the organization, perhaps when things open back up and I can come out to Oak Park again. We're not going to go there right now, but you need to understand, in my opinion, you need to understand your taxation and how it relates to the financial decisions that you make right now. And I also believe that, especially depending upon your net asset value, that you should seek some contractual guarantees. These financial products that are actuarial based are not right for everybody. I would suggest, though, that some extremely wealthy people I know own a lot of life insurance and a lot of annuities, even though they really don't need to in the same way that other people might. And I would also suggest that, that you have to be very, very careful when you are examining these products. There's a lot of unscrupulous salespeople out there that will try to push commission-based products on you for the reasons I mentioned when I first began this presentation. You have to drive out costs. A lot of financial planners like to put people in funds. This is becoming managed funds. This is becoming less and less prevalent as we go to indexed funds, for example, that have far lower costs. These may be measured in 0.5%, or we also would say 50 basis points. But you know that 50 basis points over 5 years, or rather 10 years, is 5%. And while on that subject, I'll also say this. There's a lot of financial advisors that advertise that they're fee-based only, and they disparage commission-based products. But let me ask you to ask yourself, think about what it is that you're paying for your advisory fees on an annual basis. For sake of simplicity, think of it as 1%. How much is that really over the next 10 years, especially if that asset is appreciating? If you're not even that quick at math, you'll quickly come to the conclusion that you're going to pay more than 10% in fees. Would it not be better to pay 8 or 9, 7% up front than to pay 1% per year? Maybe. It's a model that should be looked at and understood so that you really know what the true costs are of whatever financial products you're looking at. I would also advocate that as a business, you should eliminate non-performing assets. When you turn a company around, the first thing you look for are non-performing products or services, especially those that consume a lot of cost. You want to eliminate those as fast as possible so that you can improve overall performance and reallocate assets to performing assets. When you're buying products, whether you're buying securities in the market or actuarial risk or insurance and annuity products, identify and procure industry leaders. I can't stress this enough. Many of the name brands have products which, because of their sheer size, simply cannot perform as well as some of the mid-level products and carriers can. It's really a fascinating thing when you delve more deeply into it. Diversify your income streams and your assets. We showed the asset classes on the screen earlier. You've got investments, you have insurance, real estate, alternative investments, art, and precious metals. I can't remember the name of the family out of Venice, but it was a very, very wealthy, very, very old money family that said that the secret to maintaining wealth was collecting art and property. Now, that's not what I'm advocating for us, certainly, and it's not what I've done to any major extent, but it's just something that bears mentioning, I think, and it can be very fun and interesting too if you have the wherewithal. I hope I didn't go back. I said to understand wealth. Understanding wealth erosion. We're gonna speak to that with a little bit more detail now in the upcoming slides. We're going to address inflation, taxation, and uncertainty. Not necessarily in that order. Some slides will have a little bit of both, so please bear with me. And by the way, we're halfway through the presentations. I hope I can't tell whether I've lost people or if I have other people still with me or not, but I certainly hope so. Some people think that inflation has been tamed. In 2008, when I had to close my company down, it was a very, very difficult decision, of course, but we saw the quantitative easing that was beginning to happen, let alone some of the QEs that were announced and some that were unannounced, Fed actions. And many of us, I tried to salvage my company by going back on the floor, and I was being paid money that I used then to meet my payroll. And there was a lot of people on the floor that were very well informed financially, and we all thought, oh my gosh, the first recorded inflation in history was Babylon, and never in the Weimar Republic of Germany, of course, we all know the Zimbabwean inflation, South American inflations, and we studied all of them. And never has a government inflated its currency, which is to say printing more money or minting more coins or reducing the metal content of coins to, a nickel is no longer made out of nickel, than what we have in the last, call it 10 years. It's absolutely astonishing. Yet prices haven't really risen. It's absolutely a paradox. Very few people at the time would have thought that 10 years hence that we would be living in such a low price inflation environment. In fact, many people began to predict that we might go deflationary, which would be an absolute, well, I don't want to use the word Armageddon in the wrong context, but the depression that we saw in the 30s, the 1930s, was a deflationary depression. That's a truly intractable and absolutely horrifying scenario. And as you can see that we, in 2009, we briefly did go deflationary. It was a very, very, very scary time. But you can see that inflation has been relatively low. It's averaging about 3% per year for the last many years. It's a factor that many people figure into or allocate for their financial plan or planning. But I want you to understand, I think more importantly, what is the net effect of this? That the buying power of a dollar, a 1929 dollar, is somewhere in the neighborhood of 15 cents today. It's solely a phenomena of printing more and more money. So what does that mean? Does that mean that it will always continue this way? Well, I don't know. I have a slide coming up that will address that a little bit more. But if you look at the market as an inflation hedge, something that you can use to maintain your asset value in terms of purchasing power, it's a darn good one. This is a chart on the left-hand side of the S&P 500 large cap index. It's an index that's widely quoted, most people are familiar with. You can see that there's quite a bit of volatility in that index. This is going from 2009 to the current day. I printed this out this morning. And similarly, I went to quandl.com, and it's a great site for financial analysis and looking up little factoids that are useful, cocktail conversation and others, that the inflation adjusted S&P 500 is actually flatter, meaning that it doesn't rise as fast and it's less volatile than the uninflation adjusted S&P 500. Well, of course, it would stand to reason, right? Because you're taking that 3% or whatever it is out from the performance every year. Yet nonetheless, the inflation adjusted S&P 500 has appreciated faster than inflation, obviously, with a couple notable exceptions. And it can be a useful tool in your overall planning process or portfolio process to stay ahead of inflation as you go through the remainder of your life. However, we're coming to a very interesting inflection. In the fall of this past year, we became aware that the Federal Reserve was suddenly releasing more money into the market, that it had opened up the overnight window, as it's called, in a way which is unprecedented. And I remember being, I'll just name it. I was at the Union League Club with some friends. I'm not a member. There's friends of mine that are members there. And the traders that I was sitting with and others, financial advisors and accountants, were just absolutely terrified. They all thought that something was going to happen on December 31st that was unprecedented. I don't want to name it. I don't want to scare people, but we all became very, very concerned. And with my fund, I put out a newsletter about our performance. I hasten to add, is for accredited investors only, and so therefore all those newsletters and all those publications are behind a protected firewall on hedgemaven.com. I cannot publish the results of the hedge fund. I can't speak about the results of the hedge fund. It can be considered to be a solicitation. It's absolutely prohibited by the SEC and by FINRA. I can get in a lot of trouble, so I'm not going to say any more about it than that. But we started warning people in September and October, November and December that we saw market correction happening. One of my clients in the fund is a very wealthy individual who owned a lot of a concentrated position in stock, which means that he has the majority of his assets in one particular stock. It was a family business that had been sold to a major organization. And my trading partner and I just began haranguing this individual. You have to protect your stock. You have to protect your stock. You need to put some protection under the stock. And I will say to you that certain charts that we monitor and certain wave theories that we monitor suggested to us that we might see a 15% correction. 20% was completely unthinkable, could never possibly happen. Well, as you know, on the 13th of March, the S&P 500 was off 30-something%. I think it was 33%. It was absolutely terrifying. Good buying opportunity, by the way, if you had money on the sidelines and if you weren't facing margin calls, but absolutely terrifying. So what's going to happen next? Well, we've had this steady state where prices have been fairly well maintained. The cost of oil has been kept pretty low, for example, especially now with COVID. The demand is so low that the price of gasoline has plummeted, certainly. And other cost of living index members are also substantially less because demand is so down. But what about this blip now that we see in the money supply? The M2 money stock is perhaps the best indicator of real money sloshing about the economy. And it, and a measure of the velocity of money, is a very good indication of where we're going. Now, I didn't have time to get a velocity of money chart. I suspect that the velocity of money is much lower now than what it had been before the pandemic. Otherwise, I think we would see price inflation beyond our wildest imagination, perhaps even worse than what we saw in the 70s. This chart doesn't go back to the 70s, but if you were to go back to the 70s, you can see that the cost of living rose very, very rapidly, but it certainly did not match this this peak in money supply now. So what I'm suggesting is that we're in very, very uncertain times, and now more than ever, one needs to be very aware of the effects of inflation, what those effects might be on your portfolio. It's a good time to do things which are inflation hedges, and those are things that we could speak about at some point if you'd ever want. So which way will it go? Well, gosh, as I said, we really don't know. Opinions vary widely and are very tightly held. So you can basically find an argument to support whatever opinion you have right now, and it will be very well reasoned or not. Many are very well reasoned, and it may or may not be very compelling, but I don't think that anyone has a crystal ball. I will say, though, that one of the leading indicators of economic turbulence and recession is the charge-off rate. And as you can see on the left-hand side, all charge-offs, this comes from the Federal Reserve Board, are at a pretty low point. I mean, they may be rising, and we'll have to look at what happens in the next quarter or even in the next month, but it's not terribly shocking at this point, at least not to me. The market is trading at a high price to earnings ratio, but it doesn't suggest it's not historically the highest. It may be within the top 10 as you look back to 1880, certainly, but does that predict that you'll see an abject market sell-off or recession? Really hard to say. If I go back to the chart here, though, too, of money supply, I will say that it's pretty widely accepted that the excess money has flown into the stock market. I mean, if this is something that you would contest, I'd love to have that conversation with you, but it's known that many banks became investment banks and vice versa. This is with the, it's escaping me right now. I was going to say the name of the act that was overturned back in the Clinton administration, which essentially allowed banks to engage in investment banking. But what that really means is that investment banks can borrow at the Fed window. And that means that their cost of money is very, very, very low, lower than what you or I could get if we go apply for a loan. And they can use that zero cost or low cost money to speculate in the markets. And that certainly has been what we've seen. I will also hasten to add that we've essentially offshored a lot of our inflation through the expenditure of dollars into other countries. And that's another thing which has kept our own pricing low, something to be considered, I suppose. What about bonds? Well, bonds too have inflated in cost. On the left is the BND fund, which is a total bond market fund. It's comprised of corporates and governments, and I'm not sure about municipals. I don't look that closely at this ETF very often. It has a yield of 2.4%, certainly better than what you can get in the bank. But you have to understand that a lot of the appreciation that you're seeing in this fund is due to the fact that bond prices have elevated as bond interest has come down. High yield growth is or HYG is a high yield corporate bond fund. I'm not, again, advocating anyone invest in either of these two funds. I'm not suggesting that they are worthy investments for your portfolio. I certainly don't know nothing. I certainly don't know anything about you, and would never say or make a recommendation without getting to know somebody better, but just showing them for comparative purposes. I will also say that a lot of people, especially those who are in their retirement, seek yield, and they've sought yield in some instruments such as HYG. You can see that it's a little bit more than 2 times the yield of the corporate bond fund. With yield comes risk. And while we're speaking about inflation, I thought it interesting as I was compiling this presentation to speak a little bit about Medicare. I apologize too that this is a dated slide. It's about 10 years old. I looked for an update to it and I couldn't find one. But as of 2010, wages had gone up about 16% in inflation adjusted terms since 1960. Whereas the gross domestic product of the United States had gone up 168%, a tenfold difference. Meanwhile, the cost of health insurance was 818% higher. If you look, and let me see if I can get a little gizmo working here, there's a bit of an inflection point right here. Now, I don't know if we have a chat window working that I can see, but chocolate cake and coffee to the person who can say what happened in 1965. I'll give you a minute to contemplate that while I try to turn off my little laser pointer thingy here, which I thought I could do more easily. There we go. It was Medicare. In 1965, Harry and Bess Truman became the first Medicare beneficiaries at the age of 65. Why? Because Kaiser Wilhelm in Germany mandated that the government pay for people at the age of 65 to cover them in certain costs and pension. It was sort of a government pension back then because 65 was the average age of mortality. So it was a pretty good bet at that time. Well, now when people are living well into their 80s and 90s and beyond, not such a great bet. One of the most influential things that an average person can do to save money in retirement is to really understand their Medicare costs. It's not free. Many people opt for original Medicare if they're not on a corporate or union plan. Parts A, B, and now D cost money. There's a monthly premium for Part B. Many of you are already paying it, I know. There are deductibles for Part A. Part A covers the hospital bed and the nursing, but basically everything else is covered by Part B, and it only covers 80%. Part D, the drug plan, can be relatively inexpensive for most people, but the costs add up. About 6 or 7 years ago, I did a chart on what those premiums would amount to or total from the ages 65 to 90. and using a 2.25% compounded annual rate. I frankly don't remember where I got that from. I know it wasn't what you could get at the bank. I saw that an individual might pay as much as and I'm qualifying this as best I can. It's not an accurate figure, and it's certainly not something to quote unquote take to the bank, but $90,000. Imagine that. If you're married and both of you are paying those kinds of fees during the remainder of your retirement, holy cow, think what you could have done with that money. So what can you do about it? Get with somebody who really understands Medicare insurance. There's many people out there. There's different Medicare supplement plans. These are plans that supplement that 20% gap in the Part B coverage. They start out very affordable when you're 65, but by the time you're 70, I've seen people, or 75 especially, paying $350, $400 a month for these plans, these Plan Fs. Granted, you don't have a copay when you show up at the doctor's office. That's true, but how many times do you go to the doctor's office? If you're not going to the doctor's office that frequently, you might do better with a Plan N, for example. And again, I'm not offering Medicare insurance. I am licensed to do it. I don't have any appointments right now to do that. I'm just saying it's something to be considered, and it can make a significant impact on your cash flow, your current cash flow, and your asset value down the line. Also, carefully consider the Part C managed care. I know a lot of people don't like the PPOs and the HMOs. You typically don't have access to the teaching hospitals. I get that. But the premiums can be very low compared to the supplemental plans. And also, there are plans out there that have zero premiums, and typically the Part D is included. And again, think about a hospital indemnity or cancer, heart attack, stroke plan for those times, if, and God forbid they happen, where you absolutely need to have that type of support and help. Again, get with a licensed Medicare insurance agent and explore those options. Manage your taxation. When we speak about wealth erosion, taxation is one of the very top things to be considered. So hedge your inflation, manage your taxation. Tax rates. People don't realize, but as they plow money into a traditional IRA or 401k, or even defined benefit plans, which are essentially annuity-like products for pensions, that those benefits are going to be taxed at income rates on the way out. Now, they've appreciated in value, and normally in an individual account, those appreciations would be taxed at the capital gains tax rate, which is significantly less. So there are strategies that you can employ to pay that tax up front, so-called Roth conversions. There are other strategies that can be employed. This is a discussion as you contemplate moving into retirement, as you approach the age of 65, or even after, that you should very seriously consider with your financial advisor. If you have personal securities accounts, you not only get a lower taxation on the gains, but you have the opportunity to write losses off, whether they be short-term or long-term gains, losses, and that sort of thing. Roth plans are typically funded in after-tax money, or if you convert from a traditional IRA to a Roth IRA, you'll have to pay tax on the converted amount, but as that amount grows and appreciates, hopefully, you pay no additional tax on the withdrawals at that time. One of the things to really know about and educate yourself about is understanding the required minimum distributions. At age 72 and a half, the government is going to mandate that you draw down out of your qualified plans, whether you want to or not, and you will pay tax on that money. And a Roth conversion, if done beforehand, can really help offset some of those costs. Get with your financial advisor now, understand the makeup rules if you're still in your working life and you're still contributing to plans. I want to say it's at age 60. I think it's at age 60 that you can start contributing more to those plans and before tax. So I hope that's beneficial. I'm not the expert that you should speak to about this. Get with your accountant and your financial advisor. Insurance products. We talked about hedging inflation and hedging taxation, and now we're going to blend those two with guarantees or uncertainty, hedging uncertainty. So modern insurance products are more flexible now than the traditional so-called your grandfather's or your father's life insurance product. I don't want to spend a lot of time on whole life versus universal life, but I will say simply this. Universal life products are susceptible to the interest rate environment that we have now, more so than most financial products, because it's just difficult for life insurance companies to make a return. So universal life products are typically constructed where there's a level premium. So from the time that you start to the time you reach some, no, until you die, essentially, as long as you keep the policy in force. Well, that's not absolutely true. Let me correct that statement before that's quoted too far and wide. Universal life products are typically designed with a level life premium for some period of time. But the cost of insurance rises every year with your age. So early on, the difference between the cost of insurance and the premium is used to invest in some kind of side account. If it's a variable product where you can choose what the investments are, so be it. If it's an index product, it's invested in some index, whether that be S&P 500 or Mosaic or any number of other indices that are used, and hopefully the assets grow. Typically, there's downside protection. There's typically a floor to how much you will earn in a given year, and typically there's a cap. So in a year like last year, when the S&P 500 was up 30-something%, that life insurance policy sub-account would probably, or side account rather, I should say, may only yield 11 or 12%. But in general, you're protected on the downside, and you're going to participate on most of the upside. It can be a good product until the time when the cost of insurance exceeds the amount of premium. When that happens, the life insurance company will deduct from the side account an amount necessary to make up the difference. Hence, wealth erosion. What can you do about that? Well, one thing you can do is stop paying, right? Cash out of your life insurance policy. Well, guess what? If you cash out of your life insurance policy, you can get the amount that you paid in plus any appreciation on which you will be taxed. Not necessarily the most optimal outcome. Another thing that you can do is a 1035 exchange. I run illustrations for people where there are certain types of guaranteed universal life products that don't have a cash balance that that essentially operate like a interminable term insurance. The premium that you pay is essentially level for the remainder of your life, and oftentimes a guaranteed premium universal life product can be less expensive than a 10, 15, or 20-year term. It's pretty interesting. But another thing which is available to you when you own such an imploding type of product, when it begins to implode, is known as a life settlement. And a life settlement is a way for you to sell your policy to a fund or to a company who is going to pay your premiums or the premiums on the policy that you sold them. And they will typically buy these policies from you for about 10 times, and this is an estimate, please don't hold me to it, this is what I've seen, about 10 times the cash value. So if you have $30,000 in cash value, you might be able to get $300,000 for the policy. By the way, these companies and these funds are may be attractive as an alternative investment. There's one such company, for example, which is publicly traded, GWG Holdings, and they offer bonds to accredited investors, which are of the interest rates that you see here on the screen. Not too shabby. You're doing the insured a favor by giving them more money than they would normally on a cash out of their plan, and you're providing a very interesting investment alternative for people who are looking for fixed income. Circling back to the policies themselves, modern policies oftentimes come with either a no cost or for some cost rider known as an accelerated death benefit. And an accelerated death benefit is one where the insured may, if they meet certain requirements, which are to say restrictions in the activities of daily living, they can accelerate the death benefit while they're still alive. So they can use some of the death benefit to pay for expenses that they may incur if suddenly they find themselves in an assisted living or home health care or even long-term care facility. It can be very attractive. And in fact, I've helped couples set up mutual policies. They're not second to die policies. They are two individual policies where each is the other's beneficiary, and each carries an accelerated death benefit rider, so they know that a goodly portion of any long-term care or assisted living expenses can be paid for out of the accelerated death benefit. On that same note, there's modern annuity products that offer some inflation hedge. Some are even an index for senior living cost rates. And I would encourage you to engage with a life insurance broker rather than an agent. An agent will be someone who's representing a company, typically primarily one company, whereas a broker will be representing many different companies simultaneously, allowing you to choose fairly between the different policies. I happen to still be appointed with Highland Capital Brokerage, and they're the back office for Wells Fargo and Morgan Stanley and other major wirehouses. I think they're a fabulous outfit. They're owned by Ladenburg Thalmann, one of the oldest companies on the New York Stock Exchange.
Okay, so we did have a question in the Q&A.
Mm-hmm.
I can't unmute them because the question is anonymous.
Okay.
So I'm going to pretend I'm that person.
Okay.
What are the three most important things we should be doing now? Thanks. And I think if I can guess, one of the things you're going to say is one you focused on a little bit, which is to take care of your health. That seemed to be one of the things. Are there two other things you could suggest?
The first thing I think actually dictates the third. Talk to somebody. Talk to somebody that you trust and that you have reason to believe knows what they're talking about. Seek professional advice. Seek professional help. It's amazing to me how many people don't think twice about going to the doctor, when something ails them. And yet at the same time, they're reluctant, for whatever reason, to seek out a financial advisor. They think, oh, it's going to be too expensive. Oh, it's too much work. There's a million different excuses. It's like exercise, right? The hardest part is starting, right?
Right.
And there will be some turbulence. There will be some pain sometimes in the beginning. Allocating enough aside to have 6 months of living expenses covered, for example, if you don't, and other things like that. Budgeting, God, I hate it. But you need to talk to somebody. So those would be the two things that I would say. I think you're right about the health being number one, talking to somebody number two, and knowing yourself.
Yeah.
Come to grips with your relationship to your money. I have a tendency to ignore money with alacrity when I should be paying most attention to it. I just think it's going to take care of itself because I'm a sales guy.
Right. Right.
I'm just going to go sell something and it'll all be fine in the future. But do not do what I say, or do not do what I do. Do what I say. So.
Well, and I would say my worst habit is, I was a singleton for many, many years. And then once I got married, I just, when working full time and having a second job and kids, I very rarely look at our bank account.
Yeah.
And I just kind of, and I feel like once you take your hand off the gas, or you're not paying attention to what's going on, it's so easy to just be like, oh, my husband's paying the bills, because I pay some of them, but or I'm not going to pay attention to this. Then all of a sudden, once you actually need to know what's going on, you realize you haven't been paying attention for the last 5 years, and
right,
who knows what's going on. So I think always being aware of what is going on in your own monetary situation.
There's a great book that I think you would really, and I'm sorry, I'm so washed out because I have these massive monitors behind me.
You know, and I'm so dim. So between the two of us, we're like,
you look good. I look, I don't know what I look like.
Perfect. Yeah.
I look like I'm tan. I'm not really as tan as I look. My wife does the same as you say. There's a book that we got on audio books, whatever it's called on Kindle. It's called The Energy of Money.
Okay.
And it really changed my life. And I just encourage people, if they have any curiosity whatsoever, to get that book. It was very, very good. So.
Okay.
The Energy of Money. I don't know the name of the author, but you can find it on Amazon.
That seems easy enough. Yeah.
Yeah.
Did anybody else, someone want to know if we were recording it so they could look back on for notes? You know, because as you're watching it, you know, it's just going past you.
I know.
And you want to enjoy it and not just like sit and take notes. So.
Right.
So yes, we did record it. Does anybody else have any questions for Craig? I mean, it's a lot of information, you know, like last week, we got to sit back and listen to flute and piano and just relax.
Nice.
This is definitely a more active, but I think right now, you know, I laughed so hard because, you know, when I saw the program that we postponed, it was like in today's changing markets, and then
boom.
Life is a little bit different than it had you done it in the spring, but I think, you know, things are always going to be changing. So I think it's always good to, again, know what is working for you. What do you need to do for yourself? Because everybody's going to have a different situation.
That's absolutely true. And, you know, again, it's really important to understand your relationship to money. And one of the first things that they speak about in that book is like check your bank account, right? Just get back, you know, just make friends with it again, right? You don't have to do anything about it.
Right.
Just look it up every now and then and see what's there, you know, reestablish that you know, that relationship. So,
yeah. So, now that we don't balance our checkbook anymore, or some people I'm sure do, right?
I know people that still do that. And frankly, you should, right? To just have that tactile connection. I mean, that's there's a spiritual aspect to all of this too, which I won't go into here, but it's an interesting conversation at some point for some people.
I'm not going to do it.
No.
I'm going to tell you that right now, but I should. Right? I should. Okay. If anybody else has any comments, pop in.
We're gonna get into the fun stuff now.
Okay.
So, okay. So I want to just emphasize again, these life products and annuity products can be game changers in the right situation. Not for everybody, but don't discount them. There's a lot of bad press out there about various sorts of products. Decide for yourself. Do your research, decide for yourself. Okay, so I don't know how many people in this group may own income property, but it's likely that you or somebody that you know does. Now, this could be a condo someplace that you rent out. It could be an Airbnb. It could be a commercial property, for example, a multifamily unit, 6 flat, 4 flat, whatever it may be, or a small mall someplace. Any property that you own that pays an income, please pay attention. If you don't know what a 1031 exchange is, and you contemplate, or if you think you may ever contemplate selling the property, learn what a 1031 exchange is now. And the same thing with the Delaware Statutory Trust, or DST. Now, this is something that I've been making a market in to help people on a transactional basis over the last year. So a 1031 exchange for real property, like a 1035 exchange for a life insurance asset, allows for the tax-deferred exchange of tangible value from one thing to another thing of the same kind, in this case, property. It was created in 1931. There were predecessors to it, and it's an interesting economic history behind all this. What was income at the time the income tax was created? It was never wages. At that time, income was specifically monies received by the so-called rentier of the day. The rentier were the property owners, and whether that be agricultural property or living, multifamily property, whatever, income, because these people were thought to be less contributory to the society than the workers, were forced to pay a tax. And the wages that the workers earned were not taxed at that time. It's interesting. So back in 1931, they said, well, look, if you're an income property owner and you're going to sell your property and buy another property, well, we don't want to sock it to you. So we're going to allow you to do that in a tax-deferred way. So as long as it's a business use property, it doesn't matter whether you're going from multifamily to commercial office or logistics or whatever it may be. Like kind does not mean same property type. And it allows you to do this exchange, again, without paying taxes. You can maintain the complete real estate value through the transaction, but you cannot take constructive receipt, which means that you cannot take the sale proceeds. They have to go to a lockbox at a qualified intermediary, and there are many out there. These are great firms. Well, I shouldn't qualify. These are long-established, well-established, bonded firms in many cases. And also, you cannot reduce your debt. So if you have $1 million six flat, for example, you have to transfer the entire proceeds into the next property. Now, your debt, if any, will be paid down, and you will acquire debt in the next property. So if you're buying another active property to manage, you'll have to mortgage it up to the same extent as the property that you're relinquishing. However, if you're going into a Delaware statutory trust, you will oftentimes find yourself going into a similar debt situation or even more. Leveraged income, leveraged real estate can oftentimes pay more. On the other hand, some people don't like leverage. And this, by the way, can be done with no leverage whatsoever. If you don't have a mortgage on the property that you relinquish and do a 1031 with, you do not have to go into a debt situation in a Delaware statutory trust. DST, or Delaware Statutory Trust, was first established in 1988, and they were later modified in 2002 to add more protections. They're a very interesting type of real estate investment where the investors have a beneficial interest in the underlying property. They can be located anywhere in the United States. So you could have income property down in Texas and still live here in Chicago or Oak Park, but you're going to be paying real estate tax or business taxes on the real estate where it is, in Texas, in other words, not here in Chicago. And of course, the state tax in Texas is zero, as it is in a few other jurisdictions. The important thing to realize is that this real estate investment, unlike a typical REIT, real estate investment trust or REIT, actually awards a beneficial interest to the property owners. Now, the way it works is some property management company will form a trust, a Delaware statutory trust. They'll go out and they'll buy a property, many times for cash, or if it's financed, it'll be done in institutional financing levels. Many people here in the Chicagoland area have heard of Inland Securities. This is one of the first DST companies. Great Point Capital makes a market in, which is to say that we offer DSTs from all the major DST companies. There's 5 really substantial companies here in the United States, and there's several others that offer specialty type properties, like, for example, Amazon distribution centers or logistics centers of other kinds, data centers, that sort of thing, medical office. It's a fascinating area. It's a great way for people that have simply gotten to a point where they no longer want to manage a property. And again, it could be a downtown condominium that you've been renting out, or it could be a 10 flat or a 20 flat out there in Oak Park or anywhere. If you've gotten to the point where you just don't want to deal with the tenants and the trash and fixing the toilets, you can relinquish that property in 1031 and get into what I consider to be an attractive monthly income, passive income situation. So it's just something to note. And if you have any questions about that, or for that matter, any of the rest of this, you can always call me or email me, and I'll be happy to answer questions. I may not be able to help you directly with some of this. I would probably refer you to people, 2 or 3 people that you would then be able to choose from. And now we're going to get to something that this is like the passion that I enjoy right now in terms of investments anyway. So alternative investments, there's a chartered alternative investment advisor, a KAYA organization, just like a chartered financial advisor designation. The KAYA designation is very difficult to obtain and very replete or complete in the information and knowledge, the modeling. And it goes to investing in cash flowing later stage companies like private equity, pre-cash flowing or earlier stage companies, venture capital. We spoke about life settlement funds. Certainly that's a less, if not non-correlated asset, which can be a very attractive alternative for people, providing some level of non-correlation with overall market volatility. Hedge funds. According to Hedge Fund Research, which is a Chicago-based research company, they've got some 50 different categories of hedge funds. There's something like 3.2 or 3.6, depending upon whether you listen to them or the SEC, $1 trillion in hedge funds. The purest example of a hedge fund was, I think, promulgated, I'm trying to remember the gentleman's name, in 1948. And basically, it was a company, it was a fund that would go up if the market went down. That was it. So it was meant to offset market losses. Nowadays, hedge funds refer to any fund that uses leverage. That is to say, it borrows money to buy more of an asset than the money that its investors invest. Hence, can be very dangerous, can be very volatile. And the hedge may be in anything that's non-correlated or even correlated. Sometimes hedge funds invest in the market, but they do so in a leveraged fashion. And again, it's a good way to I'll just say it as tactfully as I can. It can be a good way to incinerate money. Caution is urged. I'm not advocating that people go into hedge funds here. Our fund is nothing like what I've just described in the purest sense. So, and then the other thing in which we make a market, and again, these are for accredited investors only, are proprietary offerings. They can be quite fascinating. So if you are an accredited investor, meaning that you have $250,000 income or more a year, or $2 million net worth, and if you're looking for something that may be very interesting, very altruistic, and do good or not, I would encourage you to contact me, because I've seen some fascinating technologies. For example, we've got a company that makes batteries largely out of ceramic. These are lighter batteries that can enable a Tesla to go 1,000 miles. They can enable electric powered flight. Amazing technology. I've seen medical supply companies. For example, right now we have a company that uses radio frequency conducted through a probe to weld tissue together. So imagine doing vascular surgery, which I did when I was at Loyola. It's very difficult. And you're essentially passing thread, right, through an artery, sometimes paper thin or thinner, and expecting that thread, that stitch will hold. Sometimes it doesn't, with catastrophic, disastrous results. This company offers a mechanism and a technology which can literally fuse the tissue together. It works by heating the tissue just enough to allow the collagen to unwind, and then letting it cool so that the collagen rewinds to adjacent skin collagen. Absolutely fascinating. I hasten to add that There are competing technologies, and we're evaluating this at this time, but I'm just meaning to suggest that there's some really incredible things out there. And with that, I have to say to you that I'm very, very optimistic about the future. I'm seeing really incredible health sciences technologies. I think that the promise for continued prosperity past the COVID pandemic is going to be absolutely astonishing to many people. And that's a conversation that I would rather have, face to face when things open back up and I'm out there in Oak Park meeting with you all and having lunch. But there's one more company I want to talk about before I leave this idea. We funded a company earlier this year. Its name is ADS Biopharma, and ADS is an offshoot of a technology that was discovered up at the Mayo Clinic. It's an oncolytic virus, and what that means is it's a cancer-killing virus that this particular Dr. Michael Berry bonded to monoclonal antibodies. Now, if you look at me for just a second, if you can see me, antibodies look like a Y, and they typically have two different ligands. One will bind to one thing and one thing alone. Most monoclonal cell lines, the second ligand binds to multiple different things. If you're fortunate, you can get a concentration into something else, and that's what this guy did. And basically, you can bind the antibodies to the oncolytic virus, the cancer-killing virus, which itself binds to cancer. It looks for receptors on the cancer cells that are only on cancer cells. And then the second ligand of the antibody looks for ligands on the cancer cells that are the same or different than the virus binds to. So this is a super way to target. It's like a little missile with a payload for cancer. So it finds cancer, it infects cancer, and the cells burst and die, releasing more virus that then infects more cancer. So we've got 19 different cancers that are in animal testing right now. Pancreatic and brain are hard right now. Pancreatic cancer is especially pernicious because it wraps itself in keratinaceous cells. It's very difficult to get to. Brain, there's a blood-brain barrier, but breast cancer, lymphoma, melanoma, testicular, prostate, lung cancers. We've got animal models in the works right now. I will let you read between the lines. I don't want to utter the things that I'm thinking right now, but I'm just saying that this and many other companies out there right now have astonishing technologies that are being funded in the private equity markets and the venture capital markets, and just please stay tuned. Similarly, on the energy front, there are things that I've seen that are really quite astonishing. They can render certain technologies that we've all thought were, well, maybe not all of us have thought that some of the technologies that are out there are somewhat silly because battery-powered cars have lead, right? What if they didn't need batteries? Just leave it at that. So I hope that wasn't too cryptic. I didn't mean it to be, but I have to be somewhat careful about what I say. And finally, I want to talk to you about something that's, I think, really important in the offing. The NASDAQ, the National Market System, was supposed to be the answer to the New York Stock Exchange. It was supposed to be a place where small companies could go to get public financing. And quite frankly, it never really met its promise. A lot of early stage companies didn't get the price support that they needed if they were able to avail themselves of this public market. Many companies that started out on the pink sheets never got off the pink sheets and eventually died a slow death because refinancing was so difficult, exposure was so minimal, advertising. People thought that it was the, I say in air quotes, the overbearing regulation from Washington, Sarbanes-Oxley and other rules and laws that were passed that quashed public markets. But in reality, it was the market dynamic itself, and this can be proven. It just was impossible for the average investment bank to make enough money by doing so many transactions. It was easier for them to focus narrowly on massive transactions, billion-dollar transactions and above, than it was for them to do lots and lots and lots of $50 million transactions. In part, also, this is it's due to I don't want to use the word out of control in case I'm insulting lawyers out there, but the fact is that in a litigious environment, one has to be very, very careful about the activities in which one engages, and investment banks found that it was just legally safer to engage in the larger transactions. And so the smaller transactions fell by the wayside. Well, I don't know how many of you are familiar with Archipelago, which grew here in Chicago, but Jerry Putnam and a crew of other people, including Joe Cicala, who was the laboring attorney, put together a stock quotation system before all the electronic markets happened, before Jack Sander initiated Globex at the Mercantile Exchange. There was this thing called SOAS, and it was a way of getting over-the-counter NASDAQ quotes to the common man and woman. And it was a fabulous thing. It was absolutely game-changing for people at the time. But Jerry was, I think, a brilliant man. He later became chairman of the New York Stock Exchange, and he decided that it would be really great to just aggregate everything. And if you think about it, these exchanges are way off, far distant from each other. And we're talking about a dozen or so exchanges around the United States, most of which you've never heard of, some of which you have, like the Pacific, for example, or the American Stock Exchange. And he aggregated all of these quotes into one platform. It was called Archipelago. Well, it was started with $400,000 in the aforementioned money. I think the last valuation on NYSE Arca was something like $9.5 billion, an incredible success. So Joe, over the last many years, has been engaged in mergers and acquisitions in the mid-market. These are companies with, call it 30 million in annual sales and above, but less than $1 billion. Otherwise, they would hire more expensive law firms, not better, more expensive law firms typically. And he found that the real problem was in getting price matching, that the buyer had a completely different idea in mind as to the valuation than the seller. What can you do about that? Needed to be addressed. Joe, being brilliant in my opinion as well, he's become a very good friend. So I'm a little bit prejudiced. Discovered an academic body of work which promulgates a theory known as equilibrium pricing. So all things being equal, there is a fair price. And you can determine what it is, and you can model it. So he went with academics from the University of Wisconsin, Milwaukee. I can't remember the gentleman's name right now, PhD, and went to the SEC and convinced them that there was a need for the use of equilibrium pricing, not only in mergers and acquisitions in the private sector, but in the public markets as well. And out of all that came something, and you can look this up, the Main Street Growth Act. Now, Joe, and it'll come to me during the conversation, I hope, a former Congressman, Marty Russo, here from Illinois, have lobbied Congress, both houses and both sides of the aisle, and with unanimous support bicamerally and in a bipartisan way, I don't want to try to make the word out of that right now, have drafted an amendment to the 1934 Securities and Exchange Act, which creates a brand new type of stock exchange for venture securities. These will essentially be securities that would normally have been done in the private market as a regulation D or A plus. Let's not get into the details right now, offered specifically to accredited investors primarily, but will be offered on an exchange where the price will be determined in essentially not an open outcry, not a negotiated market, but rather a price-supported market. So that as long as the company continues to hit certain milestones, which are contractually set as part of the listing requirement, the security price will remain constant or elevate. If they miss their targeted projections, of course, then the whole company may be repriced or reevaluated. But this will allow us, I think, and by the way, Joe wrote Maxine Waters' opinion on this, so there's considerable support. What we look at is democratizing at least, shall we say, capitalism, not transnational crony capitalism, It's not the capitalism I refer to, but the capitalism that we engage in here if you own like a small store or a small business. And I'm very optimistic about this because this will provide the liquidity and the exposure for many people who have great ideas that have been unable to get financing. Oftentimes it's the case that mass affluent people will take a flyer. They may invest $1,000 or $5,000 into something that allows brokers to raise a couple $1,000,000 when it's impossible to raise that same money with wealthy families. My experience in trying to raise capital up in Lake Forest was that it's incredibly difficult to raise money if it doesn't move somebody's needle. And it actually is the case, as unbelievable as it may be to people who are middle class and just normal average people, that a wealthy person will not necessarily, and mostly won't, invest in something, even like this ads that I spoke about, if it's not big enough, if it's not sure enough. If they're looking to preserve their capital, they're looking for investments that they can really understand, wrap their arms around, mostly. And they will oftentimes take a pass at investing in things which are pre-cash flow, even if they agree that these are tremendous ideas. So I think that we're going to see a spurt in American productivity and in American business like we've never seen before. And I think that that's just awaiting the finalization of this Mainstream Growth Act into law, which may happen sooner than we all think. Oh, and by the way, this is the first minority-owned stock exchange. Joe and Tom Hrinovic, his right-hand person, secured an investment from a minority-owned venture fund, and they were featured on Morning Futures. I'm not sure whether it was Monday morning or Sunday morning, with Maria Bartiromo as the first minority-owned stock exchange in the United States. So fabulous things are coming.
Okay, I don't think we have any other questions.
Okay.
So I am just going to thank you so much, Craig, for taking the time and looking so dapper. And we really, really appreciate this. This was really great. This is the 19th Century Charitable Association. It is our Monday program that we're doing virtually right now. We will be announcing our October through May program in about a month, but we do have one more program scheduled currently. It's next Monday, and it is going to be a wonderful music program, Broadway singers with a piano accompanist. You guys got to sign up for it. It's going to be wonderful. Other than that, if you like this program and you want to support us, you can always make a donation to our organization through our website, which is 19thcentury.org. Have a wonderful day, and we will see you later.